Do you know what most people do when they start investing? They pick a bunch of random investments that sound good and hope for the best. Maybe a tech stock their friend mentioned, or something new their uncle recommended at Thanksgiving dinner, or whatever their favorite YouTuber is pushing this week. And yeah, sometimes it works out okay, but most of the time, it's about as effective as throwing darts at a board blindfolded. Today, we're going to do something different. By the end of this video, you will know exactly how to build an investment portfolio that actually works. No guessing, no hoping, no random picks. And if you have been following this series, you're already ahead of the game. You have got your goals written down, you have got your accounts set up, and you understand the different investment options. Now comes the exciting part, that is putting all of those pieces together in a way that makes sense. In our last video, we talked about the three main building blocks of investing: stocks, bonds, and cash. And today we're going to talk about how to combine these, which is called your asset allocation. Let me explain what asset allocation really means. Think of it like building a house. Just like you need different materials to build a strong house, your portfolio needs different types of investments to be strong and stable. Stocks are like the frame of your house. They give you growth and strength over time. Bonds are like the foundation. They provide the stability when things get shaky. Cash is like your emergency toolkit. It's there when you need it fast. And other investments like real estate or commodities, they're like the extra features that can make your house more valuable. The key is finding the right mix of these materials for your financial house. In fact, this mix of how you divide your money between different investments matters way more than picking individual stocks or timing the market. Here's what this looks like in real life. Say we have got two investors, Sarah and Mike. Both start with $10,000, but they set up their portfolios completely differently. Sarah puts 80% of her money in stocks and 20% in bonds, and Mike does the exact opposite. He puts 20% in stocks and 80% in bonds. Everything is fine until the market crashes 30% like it did in 2020. Now watch what happens. Sarah's portfolio will drop about 24% since bonds typically help cushion the fall, though they can also drop too. Her $10,000 is now worth about $7,600, but Mike's portfolio drops about 6% and his $10,000 is still worth $9,400. So Mike made the better choice, right? Not so fast. When the market recovers, Sarah's portfolio tends to bounce back more strongly. A year later, she's not just back to $10,000, she is ahead. Meanwhile, Mike's safer approach means he likely missed out on most of that recovery. Here's the thing, neither Sarah or Mike were wrong. It all depends on what they needed that money for. If Mike needed that money for a house down payment in the next few years, his conservative approach made perfect sense. But if Sarah was investing for retirement 30 years away, those short-term drops don't matter nearly as much as the long-term growth potential. Now that we have seen how different mixes behave, let's figure out what the right mix for your situation will be. Remember when we covered investment accounts in video 2 of this series? We talked about how different accounts work best for different goals and timelines. And if you haven't watched that video yet, don't worry, I will link it below. But for now, just know that the mix of investments you choose needs to match both your timeline and the type of account that you are using. And it all starts with the most important factor: when you need the money. For any funds that you need within the next 3 years, maybe for a vacation, a wedding, or a renovation project, keep them in a high-yield savings account or money market account. Don't invest it in the market. Why? Because protecting the savings is way more important than trying to grow them. Plus, high yield savings accounts are paying pretty good rates right now, and you can get your money whenever you need it without worrying about whether the market is up or down that day. What about savings needed in 3 to 5 years? We can start thinking about investing, but very carefully. Think about 20 to 30% in stocks with the rest in bonds, and this gives you growth potential while keeping most of your money in more stable investments. And for goals that are 5 5 to 10 years away, you can take more risk because you have time to recover from market drops. And this is when a mix of 50 to 60% in stocks makes sense. And for long-term goals like retirement that are 10 years away, this is when you can focus more on growth with 70 to 80% or even more in stocks. Because over decades, those short-term market drops we talked about with Sarah and Mike become less important than the long-term growth potential of stocks. The timeline gives us a starting point, but there are two other key questions that might adjust your mix. So first of all, how do you think you would handle seeing your money drop in value? Now, I know that if you're just starting out, you haven't been through a market crash before. So try to imagine this. If you check your account and you see your $10,000 investment is now worth $7,000, what's your first reaction? Are you thinking, I need to get my money out of there before I lose more? Or are you thinking, well, that's what markets do sometimes? Or let's make it even more real. Think about how you handle other money situations in your life. When you see something expensive you want, do you tend to buy it right away or do you usually think through it first? If you're the type who makes emotional money decisions, you might want to dial back the stock percentage by about 10 to 20% from our guidelines. The last question is about what you need your money to do. Sometimes you need to take more risks to have any shot at reaching your goals. If you are 30 years old and want to retire with $1 million, trying to do it with just bonds means that you will need to save an enormous amount every month. But with more stocks in your mix, you might only need to save a third as much. And one more thing to consider is your current financial situation. Think about your job security and your emergency fund. If you have got a stable job and a solid emergency fund to cover unexpected expenses, you can stick to those stock percentages that we talked about. But if your income isn't very stable or you're still building up that emergency fund, you might want to dial back your stock percentage until you have got that safety net in place, because the last thing you want is to have to sell your investments when the market is down just because you need cash for an emergency. Having that financial cushion means that you can stay invested even when markets get tough. Most major investment firms have free calculators on their websites that can help confirm if your mix makes sense. And I will also leave a couple of them linked below. But remember, these tools are just a starting point. They don't know your personal situation or how you really feel about risk. Now that you have an idea about your mix, let me show you 3 different ways to build your portfolio. The simplest option is something called a target date fund. And think of it like a meal kit delivery service where everything comes perfectly portioned and ready to go. You just pick the fund with the year closest to when you will need the money. So for example, if you're planning to retire in 2055, you will get a 2055 target date fund. And these funds are super convenient, so they will automatically adjust from aggressive to conservative as you get closer to your target date. So they will handle all the rebalancing and all the decisions. But here's the catch. You pay for that convenience. Target date funds usually charge higher fees than if you build the portfolio by yourself. And think of this like those meal kits where they cost more than buying ingredients at the grocery store. And let me show you what I mean. A target date fund might charge 0.5% per year in fees. So that means that for every $10,000 you invest, you're paying about $50 annually for them to manage it. And that doesn't sound as much, but over decades, as your money grows, that adds up to thousands of dollars. The second approach gives you more control and lower fees, and it's called the 2-fund portfolio. And it's exactly what it sounds like. You get one total stock market fund and one total bond fund. Here's how it works with $10,000. Say you figure out your mix and you want a 70-30 split. So you will put $7,000 in a total stock market fund, so something like Vanguard's Total Market ETF or Fidelity's Total Market Index Fund. And then you're going to put $3,000 in a total bond market fund. And that's it. With just 2 funds, you now own pieces of practically every major company and government bond in America. And here's what's great about about this approach. If you want to add more money, you just keep the same split. So if you're adding another $1,000, you're gonna put 700 in the stock fund and 300 in the bond fund. Pretty simple. And because you're doing the work yourself instead of paying for automatic management, the fees might only be 0.1% or less. And that's just $10 per year for every $10,000 invested. Now let's talk about the third approach, which is the foundation and growth strategy. So going back to our house analogy, just like building one, you start with a solid foundation and frame. About 70 to 80% of your money goes into broad market funds like that 2-fund portfolio that we talked about, because it will give you a stable, diversified exposure to the whole market. Here's how this looks with $10,000. Let's say that you want to put 75% in your foundation. That is $7,500 split between stocks and bonds, maybe $5,250 in a total stock market fund and $2,250 in a total bond market fund. Then comes the growth portion, and this is where you can put the remaining 25% into specific opportunities that you see for additional growth. But here's the key with your growth investments. You want to keep each position small enough that it can't damage your foundation if things don't work out. Think about it. If you put 5% in a particular investment and it drops 50%, your total portfolio only drops 2.5%. But if you put 30% in that same investment, now you're looking at a 15% drop in your total portfolio, and that's a big difference. There are many other portfolio strategies out there, and it will be impossible to cover them all in one video, but I have made another video walking through 5 additional strategies that I will link below if you want to explore more options. But let me share 2 key principles that will help you succeed with any of these strategies. So first, understand what you're paying for. I highly recommend looking for low-cost funds because they can save you thousands over time. But here's the reality. If you don't have the time, the knowledge, or willingness to learn and manage your investments yourself, you will need to pay extra for automation. And that's perfectly fine. Just understand what you're paying for and make sure that that choice is made consciously. And second, keep your portfolio balanced, but keep it simple. When one part of your portfolio grows faster than the others, don't sell what's working. Instead, put money into what's falling behind. This is called rebalancing. And here's what I mean. Say you started with that 70-30 split between stocks and bonds. So $7,000 in stocks and $3,000 in bonds. After a great year in the market, your mix might shift to 75 to 25%. So instead of selling stocks to get back to the 70-30, just put the money of your next investments into bonds until you're back to that target mix. And the rest of what makes a successful investor, that's all about habits. And in our next video, I will show you exactly what separates successful investors from those who struggle in the market. Drop a comment below and let me know which portfolio approach makes the most sense for you. And if you found this video helpful, don't forget to give it a thumbs up because it really helps the channel. Thanks for watching. I hope to see you in the next one. Bye-bye.